residual income valuation is one of the alternative measures of fundamental asset valuation that we use alongside of the dividend models and the free cash flow models. In this session, we're going to take a look at the calculation of residual income and also some of the strengths and the weaknesses. Some of the things specifically we'll take a look at are how do we calculate and interpret the residual income? How does it relate to economic value added and market value added models that we've seen earlier and in other courses? We'll know when to use them and how to use them by calculating the intrinsic value, or what the value should be for a stock or for a company, and compare the value to those that are discussed in other models. We'll take a look at some of the determinants of residual income. We'll take a look at the relationship between residual income and price earnings multiple based on the actual and predicted values of the stock. We'll have a quick look at the difference between single stage and multi-stage models. Look at the way that growth is part of the implied value of residual income, and some of the strengths and the weaknesses. In particular, we'll also focus on some of the accounting issues which will limit the usefulness of a model like this. The idea of residual income is a very old idea in finance. It goes back to economics, and in economics, especially some of the texts that were pioneered by Alfred Marshall at the turn of the 20th century, and even going back further in a discussion by Capital in in Das Kapital by Karl Marx, looking at fair returns to capital versus returns to labor. The idea of abnormal earnings, or a word that the economists like to use, surplus profits. Terms like that essentially said that there was an idea of a fair return to capital, and anything beyond fair return would be a surplus return. Marx, of course, said that was essentially theft from the workers, who were providing the real returns to the business. And regardless of the values that are tied up in that, as investors, we're very interested when companies are able to create shareholder value beyond a fair rate of return to the riskiness of the business. Companies like General Motors, and in particular Alfred Sloan, during his tenure at General Motors, used it to value particular business segments to identify which parts of his industry, which part of his company were creating value and which ones were destroying it. We've also been introduced to the topic as part of our discussion of economic value added, or EVA. And of course, we've heard about it described as surplus versus economic profit. And it's also described as abnormal earnings, abnormal returns, and abnormal profits. Of course, EVA has practically become an industry. There is one company that essentially provides consulting services based on creation of EVA, and they provide rankings so that every year we can check in a magazine like Fortune or Canadian Business and see how various companies have succeeded or failed in terms of creating shareholder value. All of this became part of a valuation movement, which led to the idea that if managers aren't creating shareholder value, then they're failing in their duties to the shareholders. And according to this particular school, the most important function of business was to make a positive return for the shareholders, to make some kind of return in excess of a fair return. In fact, this article from The Economist essentially says that in that particular year, in 2016, when the article was published, the most popular book that was in print was a book by Thomas Piketty taking a look at inequality in capital in the 21st century. But the second most popular book was a book that's produced and regularly reproduced by an organization called McKinsey, and is one of the most commonly used textbooks in business school. It's called Valuation. Here I've got it in the 5th edition, and essentially it is the Bible of valuation. It goes through all of the different methods of analysis, and of course it's highly recommended as extra reading for the course, even though I know you already have some other reading to do. We use the residual income models, and there are several of them, as well as different types of free cash flow models, like free cash flow to the firm, free cash flow to equity. Some people would say that it's superior because it's simpler and easy to use. It starts off with simple accounting information instead of having to forecast the cash flows on a year-by-year basis. So we're using the accounting information directly. The cost of capital is, well, typically we would use a return to equity rather than the weighted average cost of capital, so that will make it a little bit easier. Also, one of the weaknesses of a free cash flow model is the amount of weight that it puts on the terminal value calculation, the numbers that we're least confident of. And so in a model like this one, we tend not to put so much weight on the calculation of a terminal value. Terminal value is only part of the stream of earnings, especially those beyond the forecasting horizon, which is typically shorter in a residual income model calculation. From one of the textbooks that we use on equity market analysis, I borrowed a couple of examples, and we'll be using those throughout this part of the session. And you can see how the calculation of residual income works. And some of this is obviously going to be very similar to what we saw when we looked at the calculation of EVA in an earlier course. In this case, we start off, in this example a European company called AXCI has got operating profit of 200 million euro. It has interest expense of 70 million euro, so its pre-tax income was 130 million. Subtract from that tax calculated at 30%, we have 39 million in income tax expense, leaving net income of 91 million. So that's the number that we're going to start out with. We also need to be able to calculate an equity charge, because this is all going to be returned to equity. And in this case, the equity charge is estimated at 12%. So if we have 1 billion euros of investment, and we have a 12% capital charge, 1 billion times 12% means we've got an equity charge of 120 million euro. Now, if we want to know what the residual income is, the earnings in excess of a fair return to capital, if we're going to use this approach, we'd simply take the 91 million euro in net income and would subtract from that the equity charge that we just calculated. And so 91 million minus 120 gives us 29 million negative. So that's negative residual income, or essentially shareholder value destroyed. If we use the approach that we saw earlier, when we're taking a look at NOPAT and subtracting from that a capital charge, when we did the EVA calculations in MBA 521, we would have started off with the calculation of NOPAT and subtract from that a capital charge at the cost of equity. Remember, we still have a billion euro in investment in the company, and we have a capital charge of 16.9% to give us 169,000. So that would give us the same result. Here the difference is that we have an after-tax interest expense of 49 million euro that is going to be added to the net income to get the net operating profit after tax. And at 30% tax rate, that's essentially where we got that difference. The capital charge is included, which is essentially the interest that is included alongside the 120,000 that was payable to equity, and that's where we got 169 from. 120 million equity charge plus 49 million in interest. And so subtracting 169 from 140 is where we got that minus 29. Same answer, just different method. So these are equivalent methods. Implications, either way, the company is destroying 29 million euro of value. If it has 100 million shares outstanding, the value destroyed is 29 million divided by 100 million, or 29 cents euro cents per share. Treated as a perpetuity, that 29-cent loss every year from now until forever would be 29 divided by, or 0.29 divided by 12%, or cost of equity, which means we're going to destroy a total value of €2.42 per share. that's how much our share price should fall. So if originally we had a share price of €10 per share, that minus the value destroyed from continuing operations, we shouldn't pay more than $7.58 per share for this firm. That's a simple application of how this works. You've already seen the similarity to EVA. EVA is focused on managerial effectiveness with respect to creating value. And in the last class we saw that essentially calculation was our net operating profit after tax minus a capital charge. And the capital charge was invested capital times the weighted average cost of capital. When it's performed by organizations like Stern Stewart, who do the EVA calculations, they make adjustments, and they say we adjust for R&D that's expensed because we don't do R&D unless it creates value, so we'll write back the value of the R&D expenses. We like to write off things because that saves us money in tax, but if we can add it back because it really created value, that might be more correct. Other things like deferred taxes are added back because typically you never get around to paying your deferred taxes as long as you remain a going concern. Inventory might be adjusted, especially if you've used the LIFO method to calculate it. Operating leases, which have to be essentially expensed if they're treated as operating leases, are treated like capital leases instead. The approach of market value added also makes some adjustment because it essentially treats the EVA as the perpetual value of the EVA that's going to be accrued over the life of the business. So essentially that is just the market value of the firm minus the accounting book value of the capital invested in the firm. Now, the residual income model, and as I said, this has been around even before we started talking about EVA and MVA, but essentially it said that the value of the company is equal to the book value of the company's assets, or the book value of the company, net of debt. So what assets have we got involved in the business? We get this from the accounts. We spent a lot of money on auditors to prove that these values are true and correct. And at the end of the process, they say this is the price per share, or the book value per share. That's B sub 0. And if the company produces no residual income, the value of the company should just equal the book value per share. But if it doesn't, it's because we've created some kind of persistent ability to generate abnormal earnings or abnormal value. And that's where we get in the second term. So the sum to infinity, or perpetuity, of the residual income discounted at 1 plus the cost of equity, because we are dealing with equity here. And so we'll take that value all the way to perpetuity. Or an alternative way of saying this is that if that is the residual income is essentially the earnings per share, E sub t, so our expected earnings per share for each period from now until perpetuity, minus our cost of equity times the book value of equity at the beginning of the year. So in the numerator on the second term, our value for this part here is essentially saying this year we're going to earn, our earnings per share are going to be so many dollars. We're going to subtract a capital charge. So capital charge is R, that's our cost of equity, times the book value at the beginning of the period, that's B at t minus 1. And so everything that we're going to look at in the next part of the presentation essentially is going to look at the calculation of these abnormal earnings. In an example here, we have the data that we're going to be using for the next few slides. Our protagonist, David Smith, is evaluating expected residual income for a French supermarket chain called Carrefour. It's got a listing on Euronext, and it's a French operator of hypermarché and small community stores all over Europe, the Americas. They have operations in India. They had been developing business in China. According to this, they have a beta of 0.72 relative to the index that's appropriate for Euronext, the CAC 40. There is a 10-year government bond rate of 4.3% that we use as our risk-free rate The equity premium for this market would be 7%. And so using CAPM to determine the rate of return, the rate of return to equity, David Smith has decided that 4.3% plus the beta times the market premium at 9.3% gives us a fair rate of return to equity. The data that we're going to be using says that the current market price is €48.83. The book value per share at the very beginning of our period, or before the beginning of our period, was €13.46. The forecasts for the EPS in 2007, 271, in 2008, 286, and the dividends that are predicted, 103 and 106. So with that information, we move on to the next part of our calculation. In this first column, we start off with our book value per share. And our book value per share was the one that we said, in the previous slide, that is from 2006. We're going to add to that because we're going to have our earnings per share, and we're going to pay out some dividends. So the 1346 plus 271 minus 103 gives us our end of period book value of 1514. That's the book value that we're going to use. In fact, you'll see that one goes up to the corner for the next year and becomes our beginning of the period book value per share. The equity charge, and you remember we said 1346 was the book value at the beginning, at T minus 1. We're going to multiply that by R, the rate of return to equity that we just calculated, 9.3%. 1346 times 9.3% gives us an equity charge of €1.25. And so, if we take the EPS that we were given as our forecast number in the third term, and we subtract from that the number that we just calculated for our equity charge, you can see that the residual income, in other words, E minus R times B in period T minus 1, that's going to be the per share residual income for that period. We do that exact same thing for the next year. Start off with the beginning of the period, book value per share that we got from the end of the last period. We have our forecast earnings per share that was one of our inputs, and our forecast dividend to get a net change in retained earnings of 180. We add that to the beginning of the period, and that gives us the end of the period earnings per share that, if this was going to go on forever, we'd add that on to our next year's forecasts. Our calculation of capital charge, we say we've got residual, we've got a capital charge of 9.3% times 1514, 141. Subtract that from the earnings per share, and that says that for the next period we have a €1.45 residual income. Now we can put all of that together and do our valuation, the beginning of the period book value, and the sum of all of the residual income. But we'll say in general that when we're looking at the calculation of this residual income, our calculation is going to essentially tell us that the rate of return, or the residual income, is going to, in the long term, or as we approach infinity, equal the difference between the actual rate of return and the cost of equity. So that's our spread, and multiply that times the beginning of the period discounted by 1 plus r to the power of t. And that will allow us to solve numbers when we're dealing with a much longer period of time. So that would be a general version of the residual income model. Here we can see an application of that, taking a look at only 3 periods. This company is a different one. It's called Bug Properties. They're treated a little bit more simple calculation. We've got 10% as our cost of equity. Our beginning of the period book value, the book value at time t minus 1, in period 1 was $6. Net income minus the dividends per share, so we're going to retain $1. So our end of period is going to be $7, and that's the number we're going to take up to the next year. The residual income is the net income minus the equity charge that we calculate. We had $6 times 10%, so that was 60 cents per share equity charge. So the residual income, 2 minus 0.61, $1.40. We do that for the 3 years, but you can see as a huge oversimplification to make this easier to solve. They paid out a massive dividend in the last period, which will essentially bring their book value to zero. So this is kind of like running a business that you're going to run for 3 years and then stop. They're essentially going to pay out all the value as one big whopping dividend. And with those calculations, you can see that the valuation of this simple 3-year life company would be the beginning of the period book value plus the residual income in period 1, the residual income in period 2, and the residual income in period 3. So $6 plus 140 divided by 1.1, 180 divided by 1.1 squared, 3175 divided by 1.1 cubed, gives us a total value of, well, $11.15. So that's how much money you should be willing to pay for this particular stock using the residual income model. A real company is always going to be more complicated. So we start off with some basic information trying to value Dell. And Dell's a little bit easier because they're not going to pay any dividends. They're a high growth company. They have got growth in earnings per share, which in a way makes this an easier thing to calculate. They tell us that the earnings are going to grow at a rate of 15%. And so our earnings in period 1, the earnings in period 1, would also be equal to 99 cents per share. Period number 2, the earnings times 1 plus the growth rate, 114. The next year, 114 times 1.15 is 131, and so on. So this gives us our predicted earnings per share for the 5 years of our forecast. The cost of capital is based on a risk-free rate of 5%, beta of 1.79, and a market premium of 8% to give us 19.03. And I think we also need one other bit of information. We need to know what the book value in period 0 was, and that was 203, I think. So with that information, we can move on to our calculations. A little bit messy, but obviously nothing if you're using a spreadsheet to do these calculations. Our book value in period number 1 is going to be the previous year's book value plus the earnings after dividends. So 203 plus the earnings per share of 99 cents minus no dividends gives us a book value in period 1 of 302. The next period, we take 302, which we just calculated, and we use that to get our opening book value. And then we add that to the earnings per share after paying out dividend, gives us 416, and so on for the 5 years in our calculation of book value. Now, from that, we can calculate the abnormal earnings. And the abnormal earnings are going to essentially be the book value. So we start off with our book value times the 19.3% cost of equity that we just calculated with our CAPM model. And we're going to subtract that capital charge that's our capital charge. That gets subtracted from the EPS in each period. So 99 cents minus 33 cent capital charge means the abnormal earnings from period 1 are 60 cents. The next period 55, 51, and so on for the 5 years of our forecast period. With that information, now we can do the total calculation of our book value per share. Now, there's a simplifying assumption. I'll get to that in a second. But essentially here we have the book value at time 0 plus the abnormal earnings for each year from 1 until the end of that chain of information. So 203, we're saying the intrinsic value or the price should be, and that P could also be could be a V or a V star. The book value of 203 plus 60 cents divided by 1.193. The second year was 56 cents divided by 1.193 squared. The third year, we have 51 cents divided by 1.193 cubed, and so on for the 5 years of our forecast period. So here we have taken the book value per share plus 5 years of forecast abnormal earnings, discounted back to the present. Why not do years 6, 7, 8, 9, and 10? Well, generally we believe, or we tend to believe, two things are important. One is discounting is going to reduce the value of those abnormal earnings substantially. And number two, it's going to be very difficult to sustain abnormal earnings indefinitely into the future. And that's because if you are showing large abnormal earnings, and you're in a business like Dell, certainly, people are going to copy what you do to create those abnormal earnings. And so eventually your competitive advantage disappears. If you have negative abnormal earnings, something's going to cause that to be fixed as well. You're going to fire the managers. You're going to perhaps be taken over by a competitor who is able to run a business. Perhaps you'll restructure, sell off part of the business. So in general, positive competition, negative, well, we're going to fix it. But beyond 5 years, we probably wouldn't bother with that information. So that is a practical example of how you would apply the residual income model. Now, you can also say, and this is where we start to talk about things like a justified ratio. Essentially, a justified ratio says that when we look at a number like price earnings or price to book, that the difference between this and what we think of as normal has to be explained by something, the justification. In this case, the justification in a market to book value ratio or a price to book value ratio comes from the company's ability to create some kind of shareholder value. And in this case, the price to book value in a justified model would essentially say that the company is able to produce some kind of EVA spread as a perpetuity. And that's essentially what the value here is with this simplified model. In the numerator, we have an EVA spread, which you remember from our earlier course. ROE minus R gives us the spread, and R minus G is the way that we discount a perpetuity. So 1 plus the perpetual value of that EVA spread would give us our value for the price to book value. And if we end up with a number that's greater than 1, then clearly the company has got a suggested ability to create positive EVA into the future. If the company's price is perfectly justified, the price is going to equal to value. The model essentially says that the market value of the company is going to equal the book value. And so a company with a company's valuation is going to equal the book value of the company at the beginning plus its ability to generate positive shareholder value at the rate of EVA spread discounted as a perpetuity times the beginning book value. An example might help to clarify that. Here we've got an analyst called Joseph Yeo, and he's evaluating a purchase of a company called Canon listed on the New York Stock Exchange. The book value per share is $18.81. The share price is $51.90. So market to book value is very high on this. Yeo expects the ROE of the company to be 16% and its growth to be 8%. The discount rate, or the cost of equity in this case, is 11%. So what would be the intrinsic value of the company? Remember, 1881 is the book value, period 0, and we're going to use that again here. And we have the ROE minus R divided by R minus G. So 16% is our ROE, 11% is the cost. And that suggests that we're able to generate, we have an EVA spread of 5%. So we're able to create wealth at a rate of 5%, discounted by the R minus G, at a growing perpetuity rate of 11% minus 8%. Multiply that by the book value at the beginning, and that says we can take that percentage of our or that factor in this case of our book value, and that's how much value we're going to create. 1881 is the book value, and it looks like a value of about $31 and something is the present value of all of those abnormal earnings. So it says $50.16 would be a fair value for this business. Now the current share price is almost $52, so it's selling for $52. It's worth $50. You're probably going to give this one a pass. It's a little bit overpriced. We'll wait until the price comes down, if our valuations are correct. Now we've heard a lot about these kind of models. They've largely been popularized by hearing about things like Tobin's Q or Tobin's quotient. And James Tobin was famous for a couple of innovations. One of them was a type of capital tax that we still hear about in times of recession, and the other was his description of a residual income model, which as an economist he kind of retweaked and gave it his own brand. Tobin's Q essentially is like the price to book value ratio and justified price to book value, except in the numerator we have the market value of debt and equity, and in the denominator we have all of the assets and not just equity. So the replacement cost of assets in the bottom, market value of capital or enterprise value in the top. And that's become a very useful model because it suggests that a fairly valued business would have a Q of 1. And as we look at the markets over time, you can see that in some periods assets have been significantly overvalued. In the 1920s, during a boom market, we ended up with a Tobin's Q market priced at about 140. And during the dot-com bubble in 1999-2000, it went up to about 1.8, which suggested that the market was significantly overvalued. So in a normal year, perhaps, we'd see a market value or Tobin's Q of about 1. Now, the reason why companies can develop a market value that's sustainably higher than the book value is because they're able to create some source of shareholder value creation that others can't easily copy. And a great term for that is an economic moat. People would say that the source of residual income must be some kind of source of competitive advantage that others can't easily appropriate. Things like a network effect. If you're part of a value chain, or probably even more relevantly, a type of business ecosystem where you have a specific role. You produce a part of a product. You produce a part of a software production process that gives you an unassailable position within that network. Perhaps you're an airline that is part of a system of airlines. For example, they have the alliances for the common carriers. So if you're part of Star Alliance, you're part of a network. And that can add some kind of value because within your particular market, you have a unique connection to other players within that network. Other things like patents and copyright could be part of that, although those things are of limited duration. Structural cost advantage because you're located closer to a raw material than your competitor, that you have you're perhaps located closer to the markets or within a market, and it's hard for others to be able to come in and copy what you do. You've created switching costs, which make it hard for your customers to switch when you raise the prices, things that our banks, for example, have become very, very good at. Perhaps you were first into the market and you tied down all the best locations, something McDonald's does quite well. When they go into a market, typically as a first mover, they locate themselves in the best locations and they partner with the best franchise partners, so the second and third entrants get the second best locations and the second best partners. And of course, if you're McDonald's and you have 1,000 stores in a market, you're able to buy at lower cost than your competitors, and so you have scale efficiency. Those things may or may not be sustainable, and if they are, then they become a valuable source of an economic moat. Things like a technological advantage tends to disappear quickly because either other people can adopt your technology, they can copy it, reverse engineer it, and so that's something we might describe as a false moat, or a moat of limited value. Some of the most important value investors, of course we know Warren Buffett would say something about this. He essentially says that moats are important. No formula in finance tells you that if the moat's 28 feet wide, 16 feet deep. We're good at calculating standard deviations and betas, but moats are qualitative in nature. It requires intuition, it requires information, it requires an intuitive understanding of the business that can't easily be summarized with a ratio or a calculation. So this is one of the reasons why residual income persists, that some firms are able to create and sustain that competitive advantage. Now, in summarizing what we've looked at in this session, the strengths and weaknesses of residual income, it doesn't rely on terminal values for a large part of the value of the business. They use available accounting information. They can be applied to companies that don't pay dividends as compared to a dividend growth model, and companies without positive free cash flow. They can be useful when cash flows are unpredictable, and they tend to focus on long-term profitability. Weaknesses, it may ignore some of the intangibles that aren't well recorded in accounting information. And if that's the case, then we may see that abnormal income can persist forever. Accounting data is the foundation, and that's going to be the next thing that we're going to look at. Accounting information can be manipulated, and often is. It's a real problem that we saw around the time of the Enron collapse in 2008, 2009, that many firms had found different ways to state their accounting information to make it look like value had been created that really wasn't. Accounting data is constantly adjusted, and as we'll see in a minute, accounting data adjustments can significantly throw off residual income because of the thing that we call the clean surplus. And the cost of debt is, just by through the simplifying mechanisms of our approach, starting off with net income, we're assuming that the cost of debt is the same as the interest expense, which in a changing market may not be true. There are many accounting issues, and we don't go into all of the detail here. I'm just going to flag some of these things so that you're aware of them. Clean surplus is essentially an approach that says, that the ability to turn earnings into net income is only able to vary with dividends. And there may be many other things that change the book value other than the retention of profits. So we're saying that values driven by ROE and book value, balance sheet adjustments for fair value may confound this, intangible assets and revaluation of intangible assets, adjustments to pensions because of a one-time adjustment because of underfunding or overfunding of pension liabilities, aggressive accounting practices, changing accounting approach in order to smooth the earnings of the business, foreign currency adjustments. Those are just a small example. This was actually well summarized in an article that was written by Barrick Lev, who's a superstar accounting professor from New York University. And he essentially said that taking a look at 20 years of empirical research into market-based accounting measures has actually produced almost nothing. And again, to quickly summarize that, the research itself was focused on something called an event study, which is essentially measuring the result of a stimulus. So we poke the market and we see which way it jumps. Things like earning announcements, dividend announcements, bond rating changes, accounting changes from one system to another, which happened a lot during the 1980s and 90s, one-off changes in research and development, so on. Things like that could create an event, and we would measure the change in the share price. So how quickly did the change in accounting information produce a change in the share price. They found overall that the correlation of earnings and share price performance was very low. Part of that would be down to noise, just irrational behavior on the part of investors. They would be buying when probably they should be selling, and so that would also be confused with a result. We would say, we'd expect, if there's a stimulus, we'd expect the result to happen the next day, but sometimes the result would happen 2 or 3 days later. And if you started to measure 3 or 4 or 5 days into the future to look for a result, you were mixing the message between several different signals. So the return window was often fudged by academics who were looking for a result. The R-squared on on most of the research was in the area of 15 to 25%. And quite often an improvement from 20 to 21% was seen to be a major improvement, when essentially what all it was telling us was that there is a lot of noise. 70% or 80% of share price performance was predicted by noise and not by the actual accounting information. So this was a very honest look and kind of a poke in the eye for a lot of academics who had spent, in some cases, 20 years writing articles trying to explain why accounting information was important. And so these were many great examples. I won't go through them, but essentially we do see that there was an awful lot of activity, and there still is a lot of activity on the effect of the measurement of book value and the measurement of earnings, and that contribution to the value of shares. So in summary, would say that residual income and the residual income models are the basis of the shareholder value movement. But they predate that shareholder value movement by decades, perhaps by centuries, going back to the middle and the end of the 19th century. It's seen as an alternative and perhaps a complementary method to fundamental analysis, alongside the statistical methods, the dividend, and the free cash flow models that we've already seen. It's based on accounting information, and it doesn't rely on the dividends or the free cash flow information. Unfortunately, there are limitations, and if the accounting information is rubbish, well, then the residual income valuation will be rubbish as well. So in this session, we've completed that trilogy of the 3 most important methods: the dividend, growth models, the free cash flow models, and now we've looked at residual income. And this kind of completes our understanding of the most important of the fundamental methods of stock price valuation.